Hello, everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate so much you taking the time here as we're at the end, ready or not, of the second quarter of 2026. And time flying by, we're in the middle of summer for sure. And certainly the first half of the year was, well, let's say not lacking for excitement. And when it comes to the markets and certainly all things economic, I guess we can say that really about all times of the calendar year. But the first half certainly had some highs and some not so high kinds of things. So we're going to go ahead and dive right into it, talk about some of the highlights that we've seen. And then, of course, the big question, what do we expect for the balance of the year? So let's get into it. A couple of big points to start the year, as measured by our most popular stock indices. So I'm looking at Dow Jones Industrial Average, S&P 500 Index, NASDAQ Composite. The first half was notably positive. Actually, I would say significantly notably positive in my end of the world, about a 9 to 12% return, depending upon which segment of the market that you're tracking. And that is, in my world, again, that would be a full year. That would be very, very positive from a return standpoint. And we had that in the first half of the year. So very, very quick start, relatively speaking. Now, it wasn't linear. Markets never are. We had a pretty big dip there in March and April, again, where things pulled back quite a bit. And you may also have some things in your portfolio which have pulled back quite a bit as well. I'll talk about that a little bit more in a minute here when we're thinking about how those indexes go together. But when you look at just the index, which a lot of folks do, they look at that as being the market performance, which may or may not be the case. We'll talk about that in a moment. But and they mark that and say, well, things are going well or things are not going well. So that's really why I wanted to share that with you. Now, let's go ahead and dive into a little bit about the indexes, because what I'm going to say next, then I'll substantiate it with the data. What I'm going to say next, it has to do with how the indexes track or how they measure performance. So Dow Jones Industrial Average is a price-weighted index, meaning if your share of stock is more expensive, you have a greater influence over the movement in the Dow. Meaning that if you're a $300 stock, you are having 10 times as much influence as a $30 stock. Kind of interesting. The companies may not be that much larger, or even it may be smaller, even though the share price is larger. And that sometimes gives us an unnatural picture of what's happening. Similar kind of thing, but different. When we're looking at the S&P 500 index, it is what's called market cap weighted or market capitalization weighted. What that means is that the larger the company, meaning the actual size, the number of publicly traded shares on the market, the larger the company, the more influence it has over performance. So think with me when you're looking at the S&P 500 index, if you're a large company and they are overrun with technology companies being the biggest ones right now. I'm looking at Google, I'm looking at Meta, I'm looking at Alphabet, I'm looking at Netflix, I'm looking at Nvidia, which is right at the top of the heap. Those overwhelmingly are the largest companies in the S&P 500 and as such have a much more significant influence on the performance of that particular index. Now, there's nothing inherently wrong with that. You may look at my body language a little bit and say, well, you're acting like this is a bad thing. I'm not saying necessarily it's bad. What I am saying is that it's important for us to be aware of how these indexes go together. Because sometimes, especially when we're looking at the S&P 500 index, we'll say, well, things are going well for all 500 companies. No, that's not necessarily the case. And actually, that brings me to my next sub point here, talking about the market performance year to date. I mentioned this just a few seconds ago. You may have a number of companies inside of your portfolio which are notably negative for the year, meaning that even though I said the indexes are positive, there are a number of very large companies which have had very negative performance this year. I'm going to use a couple just because they're so ubiquitous. I'm looking at Microsoft, notably negative for the year. I'm looking at the price of gold, which so many folks track, notably negative for the year. So those are just two instances out of what are many which have not done as well this year. So again, I'm offering that up, A, for awareness in terms of understanding how those numbers go together. B, that even when things are looking positive, not necessarily everything is positive. And then C, it's important to keep a good and healthy understanding about what the relationship of the index, of the market overall, should be with your particular portfolio. All right, that's point number one, talking about market performance. We're looking at gold. Now, gold, as I mentioned, notably negative for the year. Now, that extends into a broader realm of thought with regards to commodities, because we've also had oil and natural gas, which have had significantly positive years. Now, not all commodities trade the same. They certainly don't all move in tandem, but there has been a decided difference between gold and oil and natural gas this year. I would bring up that primarily because of geopolitical reasons. Brings me to my third point. We obviously have been in the middle of a war. in Iran here for the last several months. There have been times when it looked like there was going to be an off-road from that, and there have been times when it looks like it's escalating, and that seems to be where we are as of the time of this recording. But when we're looking at what that means for the balance of the year, it appears, outside of significant escalation from where we are right now, that the markets have largely absorbed the geopolitical risk aspect in the pricing of the markets. What I mean is that we're not seeing huge gyrations at this point in the price of a barrel of oil or in our overall equity and bond markets due to happenings in the Middle East. Now, that may change in a moment. So certainly, if the market believes that there is a significant escalation or de-escalation that happens quickly, we may see that happen. So that's something we're going to watch here going into the second half. Fourth big item, looking at what's happening here, interest rates. Folks have been talking about interest rates going up, going down, maybe wishing for them to go down, especially if you're looking at mortgages, car loans, lines of credit, all of those kinds of things. Folks, we don't see it at this point. We really don't see where we're going to have a reduction in interest rates at this time. As a matter of fact, it is possible that we could see an increase in interest rates, modestly, but an increase in interest rates a little bit later on this year, meaning the Federal Reserve Board may vote to increase the overnight lending rate, which would impact subsequently a whole collection of interest rates that you and I use, which include mortgages and car loans, lines of credit, credit cards, etc., school loans, all that goes into that mix as far as interest rate sensitivity is concerned. That could happen. Now, I know for a lot of you that won't be great news, but we want you to be aware we're seeing that out there. We're certainly seeing the futures markets that indicate that, and we're going to be watching that very closely. So again, interest rates stable for right now, may tick up a little bit. I don't see them pulling back. Markets notably positive to start the year as measured by our most popular indices. But if you look a little bit below the surface there, you're going to see some things that aren't all that positive. It's important to note that, and it's important to understand what that means as we get into the second half of the year, which really brings me to my concluding thought. Second half of the year, we're going to have midterm elections in November. Notoriously volatile for the markets in the short run. However, overall equity market-wise at this point, we're not seeing very heavy leanings on the market. We're thankfully finally seeing some cooling off in certain parts of the market. What I talked about earlier, especially some of the big technology companies that have cooled off here over the course of the first 6 months of the year, that was necessary, folks. That was important, and that will need to continue to be important. As weird as it may sound, it's really not good when everything goes up at the same time, in the same ways that it's not real good when everything goes down at the same time. So having some things that are both positive and negative at the same time, kind of like a good eight-cylinder internal combustion engine, is a good thing. So all right, so as we're looking at the balance of the year then, notably positive, interest rates the same, maybe a little bit higher, and we'll see what happens from a geopolitical standpoint. Well, friends, as always, I appreciate your time, and thank you so much for spending it with us here as we're looking at what's happening in the markets, the economy, and the world at large. I hope that you've had a wonderful summer so far. I know kids are not going to want to hear this. We're getting ready to go back to school already, and it's going to get cooler, and then it's football and bonfire season and all that good kind of stuff. But as you know, at any time, if we can be helpful to you in any way, please don't hesitate to reach out to us. Always enjoy hearing from you. Until the next time, I'll look forward to chatting with you soon.